We are covering these 8 top actively traded stocks that are bullish today. While watching price actions, let us inform you our review on GME. GameStop Corporation is making waves again, proving why it's still one of the most unpredictable stocks out there. The company just dropped its Q4 earnings, and while revenue came in light at $1.283 billion, down 28% year over year and missing estimates of $1.48 billion, it wasn't all bad news. Earnings per share came in at 30 cents, crushing the expected 8 cents. Net income more than doubled to $131.3 million, compared to $63.1 million a year ago. GameStop's cost-cutting strategy is clearly having an impact, even as sales in hardware, software, and collectibles declined. But let's be real. The real reason investors are glued to this stock isn't just the earnings. It's the bombshell move GameStop just pulled, officially adding Bitcoin to its treasury. The company announced that its board has approved a policy update allowing Bitcoin as a reserve asset. They plan to use a portion of their cash and potentially future debt and equity issuances to buy Bitcoin. And here's the kicker. There's no set limit on how much they might accumulate. That kind of open-ended commitment to crypto is a bold, if not risky, move. Investors initially loved it. GameStop shares surged 11.7% during regular trading, closing at $28.36. But then the excitement took a turn after hours when GameStop revealed a $1.3 billion convertible debt offering that raised red flags about potential shareholder dilution, causing the stock to drop over 7% in after-hours trading. A classic GameStop move, massive hype followed by an equally massive reality check. And the crypto crowd? They got hit even harder. A GameStop-themed memecoin, completely unrelated to the company, exploded 467% on the Bitcoin news, only to collapse 94% within hours. It was a brutal reminder of how fast hype can turn to panic selling in the world of speculative trading. This whole situation is peak GameStop. It's a company that thrives on big swings, high-risk bets, and a loyal retail investor base that's always ready to ride the volatility. Whether this Bitcoin strategy turns into a long-term win or just another speculative play remains to be seen. But one thing's for sure, GameStop isn't afraid to make bold moves, and for investors, the ride is never boring. Our review on GRAB, Grab Holdings Limited, is making big moves again, and this time it's eyeing a major shakeup in the Southeast Asian ride-hailing and delivery space. The company is reportedly looking to secure a $2 billion bridge loan to help finance a potential $7 billion takeover of Indonesian rival GoTo Group. If this deal goes through, it would be a game changer, consolidating 2 of the biggest players in the region's mobility and delivery markets. Right now, Grab is in the due diligence phase, trying to figure out the structure of the deal. The plan? Secure short-term financing through the loan, then likely refinance with bonds or equity later. If successful, this would cement Grab's dominance in Southeast Asia, strengthening its grip on ride-hailing, food delivery, and financial services. At the same time, Grab is also doubling down on the future of mobility. The company has partnered with multiple autonomous vehicle firms from China, the US, and South Korea to explore self-driving solutions. It's a clear sign that Grab is thinking long-term, investing in tech that could reshape transportation across the region. Financially, things are looking solid. Grab's Q4 revenue jumped 17% to $764 million, beating expectations, and it even posted a rare profit of 1 cent per share. That's a big shift for a company that has traditionally burned cash to expand. Still, its cautious revenue forecast for 2024 between $3.33 billion and $3.4 billion suggests that it's keeping an eye on market challenges in ride-hailing and food delivery. If the go-to acquisition happens, Grab's dominance in the region would be almost unmatched. But with big acquisitions come big risks, regulatory hurdles, integration challenges, and potential debt burdens. Investors will be watching closely to see if Grab can pull this off and what it means for its long-term growth. Our review on CSCO. Cisco Systems Incorporated might not always be the flashiest name in tech, but it's got a way of sneaking up on investors with solid performance and strategic positioning. And right now, analysts are saying it's in a great spot to benefit from some big shifts in enterprise tech. Melius Research just put out a bullish take on Cisco, highlighting 3 key reasons to like the stock. First, its partnership with NVIDIA gives it a legitimate foothold in the AI-driven enterprise space, something that's becoming more critical as companies race to modernize their infrastructure. Second, there's a major campus switch upgrade cycle coming in the second half of 2025, which should boost networking orders. And third, its security strategy is finally paying off, helping drive better growth and potentially improving how the stock is valued. Put all that together, and Cisco could be in the early stages of a stock re-rating. But let's talk about the numbers. Cisco's latest earnings report was solid. $13.99 billion in revenue, up 9.4% year over year, and earnings per share of 94 cents, beating estimates. Forward guidance is steady, with revenue expected to grow about 4 to 5% next year, signaling a stable business with room for upside. The stock has lagged the broader market recently, down about 5% in the past month, but analysts are betting on a turnaround as these catalysts start to take hold. Looking at valuation, Cisco is attractively priced compared to its peers. It's not a high-growth name like some AI-focused stocks, but it's a cash-generating machine with strong fundamentals. If the AI opportunity pans out and enterprise spending picks up in the second half of the year, this could be a stock that quietly outperforms. For long-term investors, it might be worth a closer look. Our review on DLTR. Dollar Tree Incorporated just made a bold move, one that investors seem to love. The company is selling its struggling Family Dollar segment for just over $1 billion, and the market reaction was clear. Shares jumped as much as 8% on the news. Why? Because for years, Family Dollar has been a drag on Dollar Tree's performance, weighing down margins and distracting management from its core business. Now, the company can finally refocus on what it does best, running its namesake Dollar Tree stores. Executives didn't shy away from the truth in their earnings call, acknowledging that Family Dollar and Dollar Tree were 2 very different businesses with little synergy. Splitting them up lets each brand move forward with a dedicated strategy. And while Dollar Tree expects a short-term earnings hit of about 30 to 35 cents per share from the sale, analysts and investors see the long-term upside. Evercore ISI put it bluntly, this is addition by subtraction. Truist Securities backed up that optimism, maintaining a buy rating on Dollar Tree and raising its price target to $84. The rationale: the sale frees up cash, unlocks tax benefits, and allows the company to put all its energy into growing the Dollar Tree brand. With expectations of 3% to 5% same-store sales growth, better than most retailers, it's clear why analysts are warming up to the stock. CEO Mike Creedon summed it up best. Selling Family Dollar lets Dollar Tree return to its roots and refocus on its core business. With a strong balance sheet, cash flow to reinvest, and a renewed focus on driving profitability, Dollar Tree is setting itself up for a fresh chapter. For investors, this could be a turning point worth watching. Our review on IAG. IAMGOLD Corporation just made a big move that has investors taking notice. The Canadian gold producer is riding high after its Coty Gold project in Ontario officially started production, an event that's been years in the making. This mine is a game changer, expected to churn out an average of 495,000 ounces of gold annually over its first 6 years, making it one of the biggest gold operations in Canada. For IAMGOLD, this marks a major turning point. The company has faced its fair share of challenges in recent years, including setbacks at its Westwood mine in Quebec and operational risks in Burkina Faso. But with Coty Gold finally online, the company is shifting into a higher gear. Analysts are already eyeing a production boost and potential cost efficiencies, which could strengthen IAMGOLD's bottom line and make the stock more attractive. Investors seem to like what they see. The stock has been gaining momentum, and some analysts are even revising their outlooks based on the long-term production potential of Coty. The mine also gives IAMGOLD a more stable, lower-risk asset in its portfolio, something that's especially valuable given the geopolitical risks tied to its West African operations. With gold prices holding strong and demand expected to remain solid, IAMGOLD is in a position to capitalize on this momentum. If the company can keep operations running smoothly and deliver on its production targets, there's a real opportunity for further upside. For investors, this could be the start of a new chapter, one where IAMGOLD isn't just another mid-tier miner, but a serious player in the gold industry. Our review on PCG. PG&E Corporation just made a couple of big moves aimed at strengthening California's grid, and investors are taking notice. The utility giant is doubling down on energy resilience, teaming up with Sunrun to tap into home solar plus storage systems, while also advancing a $43 million plan to expand community microgrids. The Sunrun partnership is all about relieving strain on the grid by leveraging roughly 600 customer homes with solar and battery storage. This could help PG&E avoid costly infrastructure upgrades while improving reliability in areas with high demand. It's a win-win. Customers get incentives for sharing stored energy, and PG&E gets a smarter, more flexible grid. On top of that, PG&E is putting serious money into microgrids, funding 9 new projects across Northern California. These microgrids will provide backup power to vulnerable communities, keeping critical services like hospitals and emergency facilities running during outages. Given PG&E's history with wildfires and blackouts, this is a strategic move to improve reliability and rebuild public trust. For investors, these initiatives show PG&E is adapting to California's evolving energy landscape, embracing decentralized power solutions instead of just relying on traditional grid expansion. The company's push into storage and microgrids could position it well for long-term growth, especially as state and federal incentives drive further investment in clean energy. If these projects prove successful, PG&E could be setting the stage for a more resilient, tech-driven utility model, one that keeps customers happy and regulators off their back. Our review on CMG. Chipotle Mexican Grill Incorporated is a fast casual powerhouse serving up burritos, bowls, and tacos across more than 3,700 locations worldwide. The company has built a strong brand around fresh ingredients, digital convenience, and a loyal customer base. But lately, the stock has been on a bit of a roller coaster, and Wall Street is split on where it's heading next. Analysts are still bullish overall, with a strong buy rating from the majority of firms covering Chipotle. But the stock has taken a hit this year, down nearly 18% year-to-date, outpacing the broader restaurant sector struggles. What's going on? A mix of margin pressures, new tariffs, and cautious guidance for 2025 have investors a little nervous. Chipotle's heavy reliance on avocados and other ingredients from Mexico means the newly imposed tariffs could squeeze its margins, at least in the short term. The company says it's absorbing the extra costs for now, but that won't last forever. Meanwhile, same-store sales growth is expected to slow from last year's 7.4% to just low to mid single digits in 2025. That's a red flag for some investors who are hoping for more aggressive expansion and pricing power. The silver lining? Chipotle is still growing, and its digital strategy continues to be a strength. The brand has a dedicated following, and if it can navigate these cost pressures without losing profitability, there could be a solid rebound ahead. For now, the stock's dip might look tempting to long-term investors, but near-term headwinds could keep things choppy. Our review on SBUX. Starbucks Corporation, a global leader in specialty coffee, has been facing some challenges recently. While the company continues to attract attention with fun collaborations, like the new Peanuts-themed merchandise collection featuring Snoopy, the stock's performance has taken a hit. Over the past month, shares have dropped more than 16%, underperforming the broader market and its industry peers. A big part of this downturn is the negative revisions to earnings estimates. For the current quarter, Starbucks is expected to report a 23.5% year-over-year decline in earnings per share, which has weighed heavily on investor sentiment. While the company managed a slight revenue beat last quarter, the overall outlook remains mixed, with analysts revising their earnings estimates lower. Despite the challenges, Starbucks continues to see solid revenue growth projections for the upcoming year, but the stock's current valuation puts it at a premium compared to its peers, earning a D grade in the Zacks Value Style score system. The company is rated hold by analysts, indicating that it might perform in line with the broader market in the near term. While Starbucks remains a strong brand with long-term potential, short-term investors may want to wait for signs of stability before making a move. Please subscribe, give the video a like, and watch more from our playlist. Thanks.